Hello, everybody. I'm Jerry Baker. I'm editor-at-large with the Wall Street Journal. Thank you very much indeed for joining us, and particularly thank you very much to my guest, Sheila Patel, today from Goldman Sachs. I'm looking forward to an interesting discussion about the markets, about what's been going on, these strange times we live in. So if I could start, Sheila, first of all, thank you very much for being with us. Let me start with you. Obviously, as I said, we're living in extraordinary times. We are in the midst still of a worst pandemic the world has seen in many, many years. The economic impact, obviously, of lockdown is extraordinary. We're still, here in the United States and in much of the world, in a pretty deep recession, coming out of it, obviously. And so we are in remarkable times. There's very little visibility, I think, about how soon this will end and how we get out of it and what things are going to be like the other side. So we're in this remarkable period of uncertainty and kind of anxiety, and we have the situation where equity markets seem to be in incredibly buoyant shape. I mean, they're obviously they fell very sharply in the early stages of the crisis, but now flirting again with all-time highs, suggesting that investors are pretty confident that we're looking at some pretty good earnings prospects and growth prospects for companies in the year or two ahead. And at the same time, we've got an extraordinary situation in bond markets where bond markets seem to be priced essentially to reflect the possibility of kind of like a permanent depression. We've got, 10-year government bond yields at 0.5. We've got, all the yields across maturities and across all types of yields. High yield as well as the safest of bond yields, all getting down to remarkably low levels, which suggests a minimum not a lot of optimism there in the bond market about a really robust recovery. Just explain this conundrum to us and explain what you think is going on.
Well, thanks, Jerry. It's great to chat with you today. And look, I think every investor I speak to globally is trying to understand this confluence of events. I do think there are a few threads of this that make a bit of sense about the direction, albeit maybe not the magnitude of some of the moves that we've seen. So, for example, as we look at where we are today, still in the midst of this pandemic, there's still so much unknown. How quickly can economies recover? Will a vaccine accelerate the rebound in various global economies? How quickly and to what economies would it be distributed? And so on the virus front. But if we go to the asset allocation front, to some extent, not putting aside the pandemic, but realizing it's a backdrop of stress that many investors have dealt with before, whether it came from the global financial crisis or something else, investors always go back to the known. And if you go back to the 2008-09 period, when you had the severe down drop in equity markets, it was actually a great time for very long-term investors to buy. And I think you saw that in March. If you think about pension funds, sovereign wealth funds, investors with 10 plus years of horizon ahead of them or more, it's very clear that significant, sharp, and to some extent, at the time, especially maybe overextended dips in the equity market were a moment to buy. I'd also point out that at the end of last year, most large institutions had raised cash significantly. They expected some kind of recession. They didn't know why. They didn't think it would be a pandemic per se, but they certainly had a negative view on where the markets could go from the end of 2019, which seems like eons ago, right? And they got to that moment and they bought. But you continue to see the market move. And there's a few more cogs in the wheel moving on that one. I mean, first of all, again, when you look at global asset allocations and you look at bonds versus equities, the prospect of where rates are, and you covered it very well, the question of when inflation might rear its head, and we can discuss that, but we think it's a mid to long-term problem, not a near-term problem. And then the reality that in a market like this, again, on a long-term basis, equities are probably the main place to look for returns rather than bonds. Most people's asset allocations have tipped that way. You can add a layer of froth on the top of that, which is retail participation in the markets. And that's a new version of a story we've seen before. It brings in tech, which you and I were discussing earlier, where you have a new generation of investors with new tools on their iPhones or smartphones, new ways to think about investing, new stocks to get excited about, for better or worse. That's not to say that was a great choice or is a great choice. On the other hand, in general, it's young investors with a long road ahead of them as well in terms of exposure to equities, but it certainly adds something to the mix.
Well, let's come on to tech in a minute. One thing I do want to ask you, I mean, one factor that seems to be very much driving this remarkable movement you're seeing right now on both equities and bonds is massive government intervention, largely, obviously, primarily in the form of monetary stimulus, but also particularly in the US, a very, very significant fiscal stimulus. But the monetary stimulus, the Fed now, once again, intervening in remarkable ways, buying up all kinds of bonds, helping to drive interest rates down and helping to provide that kind of liquidity that is presumably helping all asset prices across the board. Are we becoming kind of just dangerously addicted? This is, once again, we saw it in the early 2000s after the, dot-com crash. We saw it, in a huge way after the 2008 financial crisis. And it continued for a long time after the financial crisis. Are we just becoming addicted to these massive injections of monetary support?
Well, I certainly think investors have gotten used to big interventions at moments of big issues, right? And I think it probably was reasonable to expect big interventions in the light of a pandemic. There's almost not the same kind of moral hazard that there might be if there's a question of a financial crisis or other, which is still being debated today. Right? A pandemic is something that is extraneous to the markets and yet incredibly potentially damaging, and a bridging event where you could certainly see that central banks and regulators and institutions on the governmental side all over the world would want to support their economies and their countries during a time of stress. I think it does raise two questions for most investors I speak with globally. One is the question of inflation, and certainly wanton printing of money, which hopefully, is not something that we truly are addicted to, but printing of money certainly bodes for inflation at some point, although there are deflationary trends working against it, which we can certainly discuss, but demographics, unemployment, technology itself, et cetera. But secondly, I think as you look at central bank activity, I think one of the things that has been fascinating to speak about with investors is, the Fed bought that before it got a chance, or this central bank acted on corporate bonds, and I might have been in there alongside them, but the credit moment evaporated so quickly in March, April, when you might have seen institutions jump in. So the question is, as we try to unwind this, as you see central banks globally look at economies, maybe get them on more even footing, and they try to step back, have they left the markets in a state where institutions can step in, where institutions can buy the corporate bonds or buy the other securities that they were thinking about, but perhaps not as quick off the mark as central banks were globally?
Yeah. You don't worry them just about again, obviously with these interest rates, one wouldn't be too worried, but just the level of debt that's being absorbed, that's being issued by companies, that's being absorbed by investors, that's being bought up by governments. You don't worry that at some point this is going to turn, right? And we've seen, just take the fiscal position of the US government. At some point this has got to turn. We hope sooner rather than later the economy does bounce back from this. You don't worry about the scale of debt. People talk about these zombie companies that have, got huge, they're servicing so much debt, they're swamping their profitability. You don't worry about that as a long-term drag on economic performance?
Oh, definitely it's a worry. I think the question is it a cloud overhanging all, or is it a question of choosing the winners versus the losers, right? And seeing another example of which we've again seen before, where high yield markets go through turmoil or different sectors of the market go through turmoil. I mean, in terms of government debt, it's certainly ballooned. On the other hand, it's certainly something that governments can inflate their way out of, or that there are other potential mechanisms to see managed. When you think about corporate debt, when you think about credit, it really is a concern to figure out which companies are the winners of the future, who will be able to pay these debts off, and importantly, which companies are resilient. Are the winners of today really the winners of tomorrow? I mean, I think when you look at the reactions, when you look at the work from home successes, et cetera, that's all great news. But the sustainability of that into the economy of the future is a big question mark. So I certainly think it's a worry. Where I think the debate is still out among investors is the big overarching question on the whole bond market of inflation. Does it happen? When does it happen? And I've talked to investors across the spectrum, from one in Australia who says we'll never see inflation again, to investors in the US who have built significant TIPS portfolios and who are convinced it's looming around the corner much quicker than we expect. That is the whole tide, right?
Yeah. I mean, briefly, because I do want to get on to the question of winners and losers and, you know, where you see that playing out. But on that, where do you stand on that inflation question? Because again, as you mentioned, one way that certainly the governments have historically worked their way out of massive debt explosions of debt is through printing money and through inflation. And you know, you don't. But are you concerned about that, or do you think the other factors you described, the demographic, technology, long-term, other factors working in the other direction, will actually keep inflation under control?
Sure. Our view is there are a lot of tides against inflation for the middle to longer term, right? I think for the short term, for sure, we're not that concerned about it. The question is 3 years from now, 5 years from now. I think that's when our expectation is you get a much higher probability that we see inflation. In part, again, because of the government debt that has to be managed, but also because even though I've mentioned some trends that are counter to inflation, if you expect that economies recover, you expect that employment recovers, then it's reasonable to think that there should be some degree of inflation. Out of control inflation, unreasonable levels, there's certainly a fair number of people that think a bit of inflation is not such a bad thing in the circumstances we find ourselves in. So we expect it to return, but not in the near-term view of most investors.
And let's just look again at the kind of disaggregate the market a little bit, the equity markets in particular. You know, we've seen, while there's been, you know, general, the economic performance has obviously been generally very weak in 2020. What we've seen is an extraordinary intensification of the divergence between, you know, the winners and losers in this economy, particularly tech companies, particularly big tech companies. I mean, I think the big tech companies, you know, from a financial perspective, let alone from their underlying economic performance from a financial perspective, you know, their dominance has grown even more in the last 6 months. Is that now a feature of when we get there, ultimately the post-COVID landscape, that this will be a structural change in the economy where these tech companies, and indeed to name any other companies, that are just going to have even more entrenched power than they have right now?
I think the divergence we've seen in the markets is something that may have been coming, but was accelerated dramatically by this crisis. When we've been analyzing it throughout Goldman Sachs, our research department, asset managers, portfolio managers, we've sort of ended up in a bit of a three-phase view of it. One was the immediate phase, which we've just discussed. What did people do in the immediate aftermath of the news, the move in the equity markets, the winners and losers that were so dramatic? Because either a company stayed in business or it didn't at first, right? They could move online or they couldn't. They were prepared or they weren't. We're in a middle phase today, a transition phase, where certainly people feel like they can pick some of the winners. In fact, here we are on, you know, a video conference call we might not have imagined doing a year ago. People would have worked to find a time that you and I could be in the same place together, or up on a stage, or in some other way dealt with the physicality of engaging with others and investing and business. Whereas today, so much more is conducted this way. It's extended into other industries like healthcare. The NHS worked for 10 plus years to get a bit of online medicine going. And in 2 weeks, they had 10 million people on online healthcare, right? So certainly the transitions we've seen are dramatic. The generational shift that it's meant, these are not just millennials and early adopters on new technology. It's people like us. It's boomers. It's lots and lots of people who never expected to live life on their computers or their phones to the extent they have today that now are. It doesn't mean that the technologies that we're using today are the ultimate winners. If somebody comes along with a better version of this, where we can be walking around a conference room virtually, people will switch. The stickiness of it is really the investing challenge and question. As you go through company by company, which we do, and you think about it as an active manager, the stickiness is a question. I certainly think in some areas, such as, you know, the boom you've seen in online shopping, there are some clear winners, right? And as always, we always find acronyms for everything, whether it's, you know, FANGs or NEST or whatever you want to call it. At the end of the day, you see some winners that seem pretty sticky, but there's a whole universe of other companies for whom the question is still open.
Do you think that, and just briefly, what do you think would be the other some of the other big structural changes that will emerge as a result of COVID? I mean, people worry a lot about globalization, about the global interconnectedness, that the disruption to supply chains that we've seen will make companies, international businesses generally, countries as well, much more cautious about the way that they've worked for several decades now with just-in-time management, with inventories. They won't want to take those risks again. So we can expect to see some disengagement, some decoupling around the world. So do you think that could have an effect, or indeed what any other you think longer-term results of this that are going to impact the world economy?
Sure. Well, off the top of my head, I think of two that we just puzzle through all the time. One is what you mentioned, supply chains. People had gotten very used to just-in-time, super efficient, but maybe not super resilient supply chains, extremely linear, and maybe not the most obvious path from a globalization perspective, but because there were open borders and easy transit of goods and products, it worked. I think now networked versions of supply chains are certainly what is in mode and what can survive. And it's the same way utilities have been run for years, or other businesses, where if one part of your network goes down, you can easily switch. And I think we'll be looking for that in supply chains. The other change or question mark goes from that huge global question to a very local question. What is the future of cities? What will work from home do? I think people miss being with their colleagues. And at first we were all excited about work from home and how well it worked in the productivity, but it's a decaying asset. We're used to being in offices together. We're used to introducing new team members to the way we work, to corporate cultures, etc. So there will be some blend, but does that blend mean that people still work in cities a few days a week? Does it mean that offices become more networked themselves? What does that mean for real estate markets, for commercial real estate, and as well as residential in cities, et cetera? And that's a very local question. It could end up country by country and city by city. But I think both those questions hinge very much on what we've gotten used to and what we need going forward now that some of these weaknesses have been uncovered by this crisis.
Thanks, Sheila. And finally, just one final question. Coming into this crisis, before anybody had even heard of COVID, let's say a year ago, people, we were very excited about ESG, about impact investing, about, so-called a sort of a moral money, if you like, about stakeholder capitalism, about companies, investment in companies that were looking to do much more beyond sort of the immediate pursuit of shareholder returns. Does anything does this change any of that? Are we just into a hiatus in which maybe that doesn't get quite the attention it deserves, or perhaps even conversely, is that going to become even more important in a post-COVID world?
I think you hit the nail on the head. The first question I got as the pandemic started up was, do we just drop this ESG stuff? Does it mean that we have to focus on the portfolios and we have to focus on just getting things done? And investors ask that question, yet at the same time, in most cases, the big institutions as well as individuals decided it was more important. And you saw that start to emerge early with the question of how companies were treating their employees, how they were dealing with the crisis. We ended up testing a number of factors on the S dimension. E has been obvious and debated, but still people thought they knew what environmental was. Governance is the most widely accepted of the E, S, and G. So there weren't many questions there. But the S has been tough. It's been I'll know it when I see it question. And this crisis really sparked much more definition and identification of the ways in which the S can either add alpha or be a risk mitigator. To give you a quick example, we thought about a factor called employee morale. And we looked at a number of data points to say, could we judge employee morale at different companies? The idea was good employee morale, better work from home, better issues, to deal with during the crisis. And yet we found, when we looked at it, actually going back 10 years, companies with better employee morale in the top decile outperform the markets by over 10%. Companies in the bottom decile underperform by over 15%. And that's been true for over 10 years. So I think it's really making us ask the question to test more, think more about the factors that have impact for us as investors, as well as the stakeholder questions of employees, communities, economies, and societies.
Sheila Patel, I couldn't think of a better way to capture the mood of the moment and the perfect way to end it. So thank you very much, Sheila Patel of Goldman Sachs Investment Management. Thank you very much indeed for joining us.
Thank you.